Good evening, everyone. Sterling here with a daily market review for Wednesday, November 20th, 2013. Now, this review I probably am going to be posted on the front end of the site. The reason being is that Chad is having some net issues. I'm not sure if it was due to any maintenance they're doing after the hurricanes in the Philippines, but anyways, he's having some issues, and so probably going to end up posting this one to the front end of the site as well. So for all the new people that are listening to this for the first time, just a brief introduction to the review. The review is something I do every day in the members area. It's a little bit more specific commentary, essentially, and so it's a voice commentary where we go over past trades as well as what we're expecting the following day, the expected direction if a direction is apparent based on the current market cycle, and the exact manipulation points that I'll be looking to trade for that following day. So pretty straightforward as far as what we cover, and do a little bit of training within the review as well, so it's a little bit more encompassing, if you will. Alright, let's go ahead and get started here with the euro. Kick it off by looking at the euro going to the 15-minute chart here. And last night, the way we were looking at the euro, actually probably easier to show it on the hourly, the highest probability is that we had seen two pushes. The reason for that was, number one, we were a little short on time, and there's a day missing here, as you guys know. In yesterday's review, El Pari left out a day on the charts, but anyways, the time criteria is getting close. I mean, you came up on 3 days if you factor in the day that we're missing, and you could have called this a push here. We've been seeing very short pushes, and the reason I didn't want to call this a push because it was only 70, and so it looked like the higher probability was that we only had two pushes. Well, with today's reversal back down, it really is apparent that obviously that cycle had been completed. Now remember, there was a day missing in there, so when we look at cycle, we have three factors of cycle that we want to see come to a completion, preferably all at once. Number one is the time factor, so preferably that cycle took 3 to 4 days to develop completely. That's a good identifier for whether a cycle is possibly complete. Number two is the overall move criteria. Overall move being seeing that cycle moving 200, 225 pips or more. That's given us a good indication that cycle could be over. And then the big one, which everybody focuses on, which is fine, but not the most important, not the only thing of importance, and that is 3 individual cycles of 90 pips or more. But remember, a cycle is made up of those 3 criteria, not just one. And I think sometimes people hyper focus on the 3 individual cycles of 90 pips or more, because sometimes we'll see 2 cycles that are larger than average, maybe 120, 130 pips, and it occurs slowly over the course of 3 days. Well, in that circumstance, you have 2 of the 3 criteria satisfied, and sometimes you'll see a reversal off of that. So that's why, at the end of the day, cycle alone will never dictate entry. Okay, so what's important to understand about that is that when we get cycle wrong, that's a protection for us. If cycle were to dictate entry alone, then when we get cycle wrong, we would lose on a trade if we were entering based off just cycle. But an example like this here today, where it looked like the higher probability was that we had 2 cycles up and we're still looking for a third today, and the market did break down, what's our protection from taking a loss? Well, our protection is the fact that the manipulation did exactly as it should. As our trading time starts right here, you can see the market blew through that manipulation point. It did exactly as it should. Remember, if a level is not going to hold, the market should be blowing through that point, and never held at that level, never held the following level, and that was our protection. And the vast majority of the time, when a level's not going to hold, we don't see it set up at that point. And at the end of the day, cycle alone, again, is not the reason for the entry. The reason for the entry is manipulation at the high probability point, and vice versa. It is the reason why we don't get into trades when they don't set up either. So was there any trade opportunity in this? Well, there was a backside of the level trade, and this is a little more advanced. I'm going to walk through this, try to walk through it fairly quickly, but as you guys know, I'm kind of long-winded. So what opportunity do we have here? Well, you're looking for a third push up at this point. You come into the New York session right here, and you're still looking for a third push up, but you're below the first point. So we have 2 points here. So you know you're looking to go long off one of those 2 points, and you're already below the first point. So then what that means is that your next point, in order for the market to get into a level you're looking to go long from, is about 40-some pips away. So remember that although we may be looking for the manipulation for the overall move, that taking of orders and moving back and forth happens on many different scales. It happens on a smaller scale, and seeing computers doing it on a scale of half a tenth, a tenth of a pip, half of a pip, a full pip, 2 pips. On that small scale is what I'm getting at. Now, on that scale, we'll never be able to trade on it because we're not trading hundreds of times in fractions of a second, taking advantage of that differential in orders and providing the market maker process within that very small window. So that's one area where manipulation tends to occur, where the inducing of buying pressure, the inducing of selling pressure tends to occur, and it happens on larger and larger scales. That's why you'll see manipulation on daily charts and weekly charts as well. So with that being said, it's still possible, even if the market were to move up long term on this day, even if it had moved up long term, it's still possible to make money from a short term move to the downside within that. If you have 40 pips into the next level, well, then you have enough room to get out with a 2-to-1 take profit with a decent entry. So what we had here is we had a stop run of the backside of the level. The market blew through this level initially, but then it came into it from the backside of that level. And it came into that level, and it created a confirming entry to the downside. Came up, and the first break here on the backside of the level broke by over 4 pips, had a stop run candle, following candle confirmed down, third candle offered the pullback. Next candle after that gives us essentially the same setup. Comes up, creates a stop run on that level, breaks by at least 3 pips or more. The following candle confirms down. What are the rules of a confirming candle? Well, number 1, it needs to close below the body of the previous candle. It did that. Number 2, it needs to close in its lower 1/3 quadrant. It did that. And for the example of a short, at a high probability point, 2 very solid confirmation entries from there. Now, one of the positives about this trade is that if you're going to take a trade that is within a level, meaning a trade that is trading from one level to the next, that is a counter-cycle trade. It is a riskier trade. You know that ultimately you're going to be looking for a long once the market gets to this point, and therefore you know that that's a good exit point. That's why I say if that does not have 40 pips, or if you don't have 40 pips to the next level, you run a risk of cutting that trade short. So although it is a little bit higher risk trade, it is a trade that is a more advanced trade, something that can allow you to take advantage of some more opportunities. Now in this case, the market got into that next level and simply blew through it. So if you took your profit there, that's fine, obviously, and no long setup occurred from that point. You never had the confirmation from that point, and therefore no entry. The manipulation did as it should. It kept us out of the bad trades. And remember that often in trading, it's not necessarily how much somebody makes, it's how much somebody doesn't lose. Many times a trader can put together a day, a couple days, a week, 2 weeks of profit, and they always tend to lose it in a much shorter period of time. And that tends to be what differentiates the losing trader from the consistently successful traders. Not necessarily how much they make, because both traders can have their times of brilliance, but the successful, consistent trader, and consistent being the key word there, that's the type of trader that has very limited losses, and that comes from having a strategy that is hyper-focused on avoiding the negative trade or cutting the losing trade short. And that's what the manipulation does, and does very well. So anyways, looking at today, what's our highest probability? Well, at this point, it looks like we have a first push down off of a completed cycle, a previous cycle that is completed. Now, with that being said, we kind of have a unique situation here with the euro. This move on the euro is far outside a typical average move. This move is 160 some pips. So what I always say, whenever I have a move that is outside of the average or far outside of the average, if we look for an average move to be 90 pips, if it's 110, 120, it's not a big deal. When you get up around 160, 170, 180, that's far outside the average. And so one of the things I always say is when I have a move that's far outside of the average, I don't want to try and put an abnormal move in a normal market cycle, or what we term as a normal market cycle. And so with that being said, what I'll do here on the euro today is very simply look at the manipulation points to both sides of the price. And I do that because we have a move that is outside of the norm, and again, I'm not going to try and fit an abnormal move into a normal market cycle. So I'll simply look at the manipulation points to both sides of the price. It'll allow us to trade the second push if that's going to happen, or it'll allow us to trade their push back up if in fact this move is going to fail because it was a large move to start off the push. So anytime I have something that's outside the average, I have a very simple default. I switch back to trading like I'm in level 3 accumulation. A very simple default that covers many different scenarios. Okay, so with the pound, last night in the pound we were trading this like we're in level 3 accumulation because we were. What is level 3 accumulation? Well, level 3 accumulation is the accumulation that occurs at the end of a 3-push cycle. And so we had been in this range-bound market, just carving out a back and forth range. And with that being said, we're looking to trade both directions in that situation. So what we had here is we had the market come into the upper manipulation point, and really, as far as trades goes, we're going to talk about this one in the context of just the mechanics of this trade. But this trade was around the time where we had the official MPC votes as far as the rate vote and the asset purchase vote as well. And so obviously we don't want to be taking a trade going into that. We have a very simple rule, and that rule is geared towards not necessarily trying to capitalize on every move, but more like what we talked about a minute ago, which is limiting losses. That's our hyper focus, if you will. And so that rule that we use in and around news is if you go back and you look at news and you can see that the market, with that specific news release, moves the market more than 15 pips, or has the ability to move the market more than 15 pips. If in the last 6 months it has moved it more than 15 pips, I do not want to carry a trade going into that news. The bottom line is, when you carry a trade going into news, you are giving the broker a license to steal from you. Time after time, if you go on a website like Forex Peace Army, you go look at the reviews of a broker, and you go look through the reviews. A good example is like MB Trading. Now, MB Trading overall has been a good broker for years. They're not quite as good nowadays because they've switched their model. It's a long story. I'm not going to get into it. But for years they were a great broker. But during their heyday of being a great broker, there was repeated negative reviews about them. And what you would see is, on non-farm payroll, MB slipped me 80 pips, or on non-farm payroll, it slipped me 30, 40 pips. On a rate decision, it slipped me 60, 70 pips. And they get a bad rap for a time where the person to blame should not be the broker. The person to blame should be the person taking the trade during those times. If you're taking a trade during those volatile times, you are again giving the broker a license to steal from you, and that's why we put that rule in place. Will it keep you out of some good trades? Of course it will. Is it going to serve as a protection? Of course it will. And so it's all about controlling risk. That's one of the big ways that we can control risk, simply avoiding those times. Okay, so the mechanics of this setup, let's forget about the news. Number one, comes in, breaks the high probability point by 3 pips or more. That initiates a potential stop run. Following candle, does the following candle confirm down? Yes, it does. It closes below the body of the previous candle, and it closes in its lower 1/3 quadrant. Therefore, second candle is a nice confirmation down. Now, on a large candle like that, it's usually unlikely to get enough of a pullback to warrant taking a position. Because remember, it has to pull back to within 15 pips of the high in order to allow for a 20 pip stop. What we see, though, is we see the market immediately within 2 candles pull back to well past high. So the entry would have obviously came out of the second candle, got well with, or the second candle after the confirming candle, fourth candle in the setup. And remember, confirming setups are 5 candle setups max. So pullback came on what was the fourth candle, and had the news not been there, that's where the entry would have been. So there's the mechanics of that setup. Now, looking forward at using or the breakdown of a level, one of the things that I wanted to point out is I'll get the question of, okay, now Sterling, if the market breaks through a level and then comes back into it again from the opposite side, you'll look to use it, but when do you choose to not use a level? And the pound is a good example of when I start to hesitate to use a level, or I don't use a level, and that is when the market goes back and forth, up and down through that level. When it's very simply violating that level to both sides, back and forth, that's a good indication that you don't want to use that level. Now, there's a far cry between the market coming up, testing a point, rejecting through that, or rejecting off of that point, and coming back later and breaking through, and then coming back down, testing, or creating the stop run if we're going to be taking a trade off it and running off from there. There's a far cry between this happening, with the one break in between, and seeing something like this, where you're just working back and forth, showing absolutely, showing no consistency as to that level being a valid point that the market is respecting. I mean, if you're breaking back and forth through it repetitively, obviously the market's not respecting that point. That begins to break it down for me. So where are we at then with the pound? Well, as far as the pound is concerned, we were in this level 3 accumulation, again, just sideways price actions, level 3 accumulation. We created a stop run on the highs and gave what looks like a first push down. So as far as the pound is concerned with this move here, this move was about 100 pips to the downside, pretty well within the average. With that being said, I'm going to look for the second push to the downside on the pound. What we'll see here, it's going to be interesting to see if we can begin to break down. Been holding the 200 EMA very nicely, and that's always a very, very strong point. So should we get a break through that after a potential retrace up before the continuation down, should be a nice move to the downside if in fact that does occur. So it'll be interesting nonetheless. So what levels are we going to look to trade from on the pound then? What levels are we going to look for the second push down to occur from? When choosing manipulation points, the first thing I want to look for is previous turning points in the market. Why is that? Well, above all else, there's nothing else that will dictate retail order placement with a greater probability than previous turning points in the market. Support and resistance, hands down, dictates order placement more than anything else, because it is used more than anything else by the greatest array of traders. So with that being said, when I have previous turning points in the market, those are always going to be my starting point for choosing a potential manipulation level. Now with the pound, because it made a pretty well straightaway fall to the downside, you have very limited levels to choose from. So when I choose a level, I choose a level that, one of the sayings that I always say when choosing a level is the rest of the market looking at this level? Because if not, then I would rather miss a trade than try and force a trade on a level that is kind of a weaker point. Now in this case, the best point that we have, a point that we used previously, a point that has been getting some response back and forth, was the 1.6107 level. This level is obviously still holding somewhat, looking at the last 24 hours. The previous Asian session held very well. In fact, the market created a stop run on that level before ultimately pushing up at the beginning of the Asian session, or at the end of the Asian session. We broke down below that level came back up, held on it multiple times. So although not an exceptional level like an overall high and overall low, it's really the best that we have on the pound. And it's kind of unfortunate with the pound because you do have a clear, from the sense of a cycle, the pound broke the highs, induced the buying pressure, and they proved they're selling into the buying pressure by the push to the downside. So that's a good indication that that could be a start to the first cycle down, or that could be the first cycle down expecting the second. The trouble is it's hard to pick a potential point here for the continuation down or for that stop run to occur. So the best point that we have is 6107. I mean, it's possible we have a fresh level created during the session, meaning if the market comes up, creates a high, pulls off of that high. What happens when a new high is established? Orders begin to be placed around that high. Is it a coincidence that the market then later comes up, takes out the highs by a few pips, and then finally runs down from that point? No, that's what we look at, or that's what we look at and call a stop run topping formation. Another possibility as a fresh level could very well be created looking forward. But the first point I'll look to use is going to be that 6107 level. Beyond that, I don't have a great level. I mean, obviously, if the market came all the way back into the highs of 6176, I would look to use that as well. But it's very unlikely it will reach that point and then continue to the downside. So the best point that I see here is 6107, and if we break through that, break above that, I would have to see something like we just drew out, a potential stop run topping formation, if that thing is going to continue to the downside. So a little unfortunate with the level there, but it is what it is, and we'll see what happens with the pound. Now with the euro, like I said, I'm going to look to trade the manipulation points to both sides of the price on the euro. The reason for that is the size of the move being so far outside of the norm. It's hard to say that it is a true first push down because of the fact that that move is, again, not your typical average size, and thus hard for me to have faith in that push to the downside as being a true first push. So with that being said, looking at the manipulation points to both sides of the price, what levels are we going to look for? Much like the pound, anytime you have a very aggressive straightaway push to the downside, there's absolutely zero response as the market moved down. It is very difficult to choose a level because the market never responded to any level on the way down. Therefore, how can you expect it to respond to the level on the way back to the upside? And that's the difficult part here. So we'll start off with what's clear and what's pretty straightforward. And the overall low is the obvious first potential manipulation point for a long setup. Remember that I'm not looking for a test of these levels. For anybody that's new and hearing this for the first time, as more than likely a lot of you will because I'll be posting it for Chad's commentary, we're not looking for the test of these levels. You guys have all traded support and resistance strategies in the past, more than likely you have, and I don't have to tell you the results of them. What we're looking for is the manipulation that occurs in and around those points. If you don't understand what I mean by manipulation at those points, start looking through the videos. Look for the confirming entry explanation. There's an explanation of the confirming entry in the videos section on the site. A lot of information on confirming entries and seeing what manipulation actually is. Actually detail the confirming entry in one of those videos. I think the video is called Complete Entry Strategy or something like that, but it details a confirming entry. And if you're new, you don't understand what we do when the market reaches these levels, that's a great second video to watch if this is a new thing for you. So that's going to be the first point I look for to the downside as it comes into that level. Now, moving down a bit further, if we're going to look to hold for a potential push up, what we had is we had some solid points going back a bit further. And the next point that we're going to run to is a point that we used in the past, 33.94, and continuing to move below that, although unlikely, I think we'll see that level is going to be the 33.66 point. Why am I looking at those levels? Well, what happens in and around a previous low or a previous high? Anytime you have a major swing point in the market, an overall high and overall low, you are going to have a massive orders in and around that point. So a simple test of that level is generally giving you some information, but when you see the false break of that level and then the confirmation back the other way, you have a strong indication that smart money has taken orders at that point. Remember that if smart money has induced buying pressure, in other words, induced selling pressure by breaking through a low. What do I mean by that? Well, when you break through a low, what type of orders are triggered? You have the stop loss for anybody that's long, putting their stop below the low, so they have to sell that position back. That's one type of sell order. You also have those that are selling on the breakout. So generally below a low, you have a lot of selling occurring, and above a high, you have a lot of buying pressure taking place. So with that being said, if you see the manipulation at that level, and you see a low taken out with the false break, then see it reject right back up above it, you have a very strong indication that smart money has just induced the selling pressure and bought into the selling pressure. If they are buying into selling pressure, it's not going to be that's not the end of why they bought into that selling pressure. They bought into that selling pressure to drive the price to the upside. Strong indication the market's going to make its move up. So that's why those overall lows are very important to us. Again, 34.15, the new low that we created today, 33.94 and 33.66 going backwards. Now the difficult part is going to be our upper manipulation points. Really crappy upper manipulation points and difficult points to choose from. As far as to the upside is concerned, if you look back, you had some tests here as far as our last test around the 34.42 level, but you don't really see any response going back. It's a difficult point to choose from, but those are the only retracements that we have. So that's the first point I'm going to choose. Understand it's a mediocre point, guys. Unless you see a very clear stop run of it, I'd be reluctant to take a short from there. I would be much more apt to see the market at the beginning of London come up, create a fresh high, pull off of that high, and then come back later for the stop run before ultimately pushing down. What happens in this situation? Well, the same thing that happens around the previous lows I was just talking about. A fresh high is created. What happens at a high? Well, people start to go, as the market turns back down, people begin to short, and stops are placed then above the last high. If anybody shorted from a turning point, generally stops are placed above the last high. If they're short, they have to put a buy order to buy that position back. And then when smart money comes up for the second test, they trigger those stops, which are buy orders, thus allowing them to sell into those buy orders. Because remember, for every buyer there's a seller, for every seller there's a buyer. The entire principle of what we do is that smart money is searching for liquidity every day. Therefore, they have to search out the buyers to sell into the buying pressure. They have to search out the sellers to buy into the selling pressure. So this manipulation, it's not a coincidence that you see these false moves occur just prior to large moves. Why is that happening? Because they need the buyers if they want to sell. They need the sellers if they want to buy. That's exactly what happens on a small scale right here in what we term as a stop run topping formation or a stop run bottoming formation. The second leg comes up, takes out the highs of the previous, the previous highs, induces the buying pressure. They sell into the buying pressure and run the price down from there. So we have a very limited level to work from. Kind of a mediocre point here. 30, as far as our first level, 34.42 to the upside. I'm going to leave the same point that we used yesterday, and that's going to be the 34.97 level. Again, I'm going to leave that point in there, and I'm going to leave it in because it proved itself as a solid point in the past, and thus, while I'll continue to leave that in, we'll actually call it, move it down a pip, 34.96, and just split the difference between those past tests there. So to the upside, the 2 points that I'll look to use, again, 34.42 and 34.96, and possibly what we had just drawn out if we see some form of stop run topping formation form in this kind of no man's land. That's always a possibility as well. Alright guys, that's going to do it for the review here today. As always, if anybody has any questions, feel free to shoot us an email. We will be happy to get back with you. For all the members, I will see you guys in the room bright and early at 9 a.m. You can, for anybody that goes for the London session or shows up for the London session for Chad, I do not believe he's going to be able to get there today. I will put a final announcement above this review in the members area, and I'll probably do it on the front end of the site as well. But I don't think he's going to be able to get there. He's had a tough time even with cellular service there the last day, which is really quite strange. I'm not sure what happened because his service is great even after the hurricane. So he thinks there was some issue with the tower, some work they're doing. But anyways, everything should be fine or fortunately this is Thursday, so he has until next Tuesday to have it worked out for the room. But don't think he's going to be there for the London session today. But the New York session obviously will continue as normal. So I look forward to seeing you guys there. And until then, happy trading.